The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to this NGPF webinar on index funds. My name is Tim Ranzetta and I am here with Abby Alcala, and we are excited to share with you our first in a three-part series on investing. We know index funds are an area that folks are incredibly interested in, and so let's get started. Well, when you talk about index funds, you have to start with a little bit of humor. So I'm going to give you a minute to read this Dilbert cartoon strip. All right, the reason I love this cartoon strip, number one, it was written in 1997, so that's almost 22 years ago, and my guess is the investing market has changed pretty dramatically in terms of people not only aware of index funds, but investing in them also. Unfortunately, in my travels around the country and asking teachers whether or not they're teaching index funds, we're not seeing as much awareness, which is why I'm so glad that you're here with us today. So this is going to be a little bit different than our typical webinars in that I think teachers as well as students learn best by doing. And so we are going to use the question box heavily. We're going to really use it as a chat box. And so that is, you'll see on your right-hand side of the screen, I'm showing it here, you'll have an area where you can type questions in. So just to give you a little bit of practice and to find out who's on the line, I would love if you could just type your name, what subject you teach, as well as where you teach. Because again, we're going to be making heavy use of the question box to get you active and participating. So I will give you about 30 seconds and Abby will let me know as folks are coming through. All right, very cool. Thank you for, looks like everybody is familiar with that, and appreciate having people from all over the country joining us today. So here's what I'm hoping to accomplish, we're hoping to accomplish over the next 15 minutes. First of all, on the content side, really just help explain what an index fund is. And we're going to give you a couple different ways that you can deliver that information to students in terms of an explanation. Secondly, if we're talking about index funds, we better understand why we're talking about them. So we're going to talk about why they are such a popular choice, not only for new investors, but old investors alike. And then lastly, if you're going to invest in index funds, if you're going to make any investment, you better understand what you're investing in. So we're going to look at some of the fine print, give you experience of looking at a fact sheet for an index fund and being able to basically assess whether or not that is a fund you want to sink your hard-earned money into. The second aspect is we're going to give you an opportunity about really reflect on these resources. So as you engage with the resources, you're going to have kind of both your student as well as your teacher hat. I want you to think about really how you would use these resources with your students, whether there's customizations you'd have to make or how you'd get them to fit within your curriculum. So again, this concept of two hats. So do the exercises, the activities that we ask you, to participate in as a student, but also be thinking in the back of your head how you might use this with your students. So without further ado, your first assignment, and that is to read this passage. And here we're trying to get at the question is, what is an index fund? So I'll give you, this is about a 1 minute read. And then we've got 3 questions for you to answer. And again, we'd ask you to put those into the question box. And if you could number them, that would make it easier on us. But the questions are, in your own words, what is an index? Second question, name 2 advantages to investing in index funds. And lastly, is investing in an index fund a safe investment? Ready, go. All right, 30 seconds. Thanks. We're getting a lot of great responses through. I'll give you another 30 seconds.
All right, folks, as you guys are wrapping up, kind of reading this page, and then you have your 3 questions, I'm going to shout out a couple have some answers that kind of stuck with me. One of them is Amanda, who said that an index is an indicator. She says an index fund is a way to automatically diversify your investment into multiple companies or a weighted market. Thanks, Amanda. You also have Selena, who said, this is a really great imagery that you can even use with your students. An index fund is a collection or a bucket of stocks or bonds. Love that analogy, Selena. Thanks. And then kind of looking at answer two, a lot of people said great things about low management and having a diverse range. And that was kind of uniform across a lot of those answers for question number two.
Cool. And then we make the question three a little more challenging by asking if it's a safe investment. Obviously, the key is how you define safe. And so obviously any stock market investment carries with it some risk. However, you're probably carrying a lot less risk by investing in an index that has up to 500 companies in it, like the S&P 500, versus making an individual stock investment. But I think it's important that students do understand that any equity or any investment in the stock market carries with it some risk, but you can reduce that risk, but never eliminate it. You can reduce it by buying a more diversified set of companies. All right, so the next way we thought you would enjoy explaining index funds to your students would be having them watch this video. This is a conversation between LeBron James and Warren Buffett. I think some of you may have seen it, but again, we're looking for multiple ways to be able to explain this concept, which is new for most students. And so what I'm going to ask you to do is, we provide the bit.ly link here, as well as Abby's just going to put that out on, she put it out on chat. You can click on it. We're going to have you, it's basically a 3-minute video. And as you're watching the video, if you can just jot notes down into the question area, and the two questions we want you to answer is, how does Warren Buffett, the country's and the world's, one of the world's best investors, how does he explain index funds? Because I think he kind of explains it in a novel way. And then who does he recommend should be investing in index funds? So again, we're going to give you about 2.5, 3 minutes. That's the length of the video. Ready, go.
And then one last note, as you guys are watching the video, when you're entering your answers into the chat box, I'm going to have you type in 1, period, your answer, and then within the same message, 2, period, and your answer. So it's just all one package. Thanks.
All righty, we'll give you 1 more minute.
All right, so we're going to wrap things up with your video. If you have not finished it, go ahead and watch the remaining of it after this webinar. But we have a lot of really great answers from questions 1 and 2. We had, let's see, Scott says, Warren explains index funds as owning a piece of America at a decent price over a long time. Thanks, Scott. A couple other people said similar things. And Warren really does include, or Warren Buffett includes some other really great advice, such as like owning or having low cost diversified index funds over a long period of time. And I think that kind of one of those key points is to really start early. And that's what he portrays to LeBron there. And then for number 2, a lot of people are saying, looking through your guys' answers, who should be investing in index funds? Some people are saying 99% of people. Some people are saying for those who aren't, who don't really know much about investing, and so something that they can easily rely on to bring back positive gain there. So yeah.
Awesome. Yeah, the reason I love this video is this is the guy who's one of the best all-time investors by picking companies. And what he's saying is this is a pretty hard game to do. And so why even try? And then the fact that he takes what the advice he gives LeBron, which appears to be a pretty special case given the net worth of LeBron, and then applies it across the board. So it's, again, I don't know how your students will connect with somebody like Warren Buffett, because he's obviously a little bit older than them. But I still think the messages he's delivering are incredibly valuable. So let's take a step back here, because we've been throwing around a lot of terms here, and I think it's important to understand the context. So the way most individuals invest, obviously you can invest in individual stocks, but the way most people invest, particularly around 401k plans and individual retirement plans, is through this wrapper we call a mutual fund, which, as Selena said, is like a bucket or a collection of stocks. And so you basically have 2 choices when you invest in in mutual funds. You can invest passively, where you say, you know what, I'm happy with the market return, and you can do that in stocks or bonds, other securities too, but we're trying to simplify things here. So that's the passive side, which we're going to spend a lot of time on, and index funds are an example of a passive mutual fund. The other is what are called active funds. And so this is where you're actually trying to beat the market. And so I always find analogies, like we have to use analogies when we're talking about investing with young people, because they don't have the context, they don't have experience. And so how do we bring it into real life for them? And so this was something I pulled off. Any of you looking for good places, real informed forums, the Boglehead blog, B-O-G-L-E. Bogleheads are basically named after Jack Bogle, who unfortunately passed away earlier this week. I would think of Jack as kind of the patron saint of index fund. He was the one who brought index fund investing to the masses through a company he founded called Vanguard. So this was an idea that came from that. And basically, it's using M&Ms as a metaphor for investing. So on one hand, you have, individual M&Ms. The second option would be you could either buy individual M&Ms, kind of challenging to do because they're typically wrapped in packages with multiples. You could go and send someone to the store to get the right colors for you. So maybe I only want 20 greens and 15 yellows and 33 reds. Or I could go out and just buy a bulk case of M&Ms. And the analogy he used was, when you think about individual M&Ms, that's the equivalent of stocks. When you combine them together, but you get somebody else to do that for you, that's active mutual funds. And you can imagine sending somebody to the store and buying individual packets of M&Ms and pulling out different colors, although I realize now you can actually buy one color at a time. But back in the day, you could only buy individual packets that had all the colors mixed together. You can imagine that's pretty time consuming and costly to say, I want 20 reds and 20 yellows and 60 reds. And then the final is where you really don't, you're more passive. You're just going out and buying the bulk case of M&Ms and deciding whatever comes up, but you're really not doing anything. And kind of when you think about risk and you think about cost, I think it's pretty clear to folks what that looks like with those 3 options I'm showing you. 2 other quick analogies that I've seen to describe. And here the analogy is kind of what is the difference between active versus passive investing. And traffic, which I know as we travel across the country seems to be an issue in most metro areas. You think about the folks who are dashing in and out, where you have a situation like the picture you see, where nobody's going anywhere, but somebody's trying to get in and out of traffic. They're slamming on the brakes, they're speeding up, they're braking, and yet you're just staying in one lane. And how often have you passed that person who's going in and out? Not to mention the fuel loss they have because they're constantly accelerating and decelerating, as well as the brake pads. So again, active can get you ahead in the short run, but it tends to lower costs, and sticking in your lane kind of tends to do better over the longer term. And then the tortoise, I think the story of the tortoise and the hare, I think, is another one where the hare may pull ahead of the tortoise at times. However, it doesn't really, it's not sustainable, which is kind of why, again, another good example. Active managers may be ahead of the market for a period of time. And there's a great case, a fund manager at Legg Mason named Bill Miller, who beat the market 15 years in a row and then gave back a tremendous amount of those gains in 2008. Why? Because he had invested in financials and housing stocks, which had done remarkably well for a long period of time, and then got battered. So he was far ahead, like the hare, and then actually fell below, in terms of what his returns were, fell significantly below where the market was. So I think those are two analogies to help. So then there's this kind of logic aspect of this, where as students, as anybody's thinking about, hey, what makes more sense? Should I hire a professional? Should I hire an active manager to try and beat the market because they have fancy degrees like MBAs, because they're paid extremely well, because they spend every waking moment thinking about individual stocks and how they're going to beat the market? Or am I better off just buying the market? So this is a question of the day that we have over a recent 15-year period. What percent of professionals investing in large companies beat the market? And so if you've seen this question of the day before, I expect you're going to get the right answer. But if you haven't, I'm interested in hearing. So why don't you put that into the question area, and we'll see what answers folks have. 30 seconds, go.
All right, so we have a pretty wide range here. Some people have said 0%, as low as 0% or 1%. I see 2%, and the highest one we have here is 50%. So we got a couple of 30s in there too. So it's quite a wide range. So Tim, what is our answer?
So the answer is, this takes a little bit of explaining to do, but this is a chart that comes out every 6 months from a group called SPIVA. They have compared all large cap funds. So large cap just basically means big companies, large capitalization, which they compare those folks managing large cap funds with the S&P 500. That's the benchmark. That's the comparison index. And the index, the percentages you see here are the percentage of time the index wins. And so the index over a 15-year period beat 92.43% of those actively managed funds. And so the answer is 8%. And so the challenge is, yes, less than 1 in 10, of those actively managed funds beat the market. The challenge is, even if you think you could pick those funds, there's a lack of persistence. So in other words, folks who do well one year don't necessarily have performance that persists in future years. So it's just really hard to figure out who that is going to be ahead of time. And so what are investors doing? They're voting with their feet. And so there's no better way to display that than this graph, which basically shows over the last 10 years, since the Great Recession, $2.1 trillion, that's trillion with a T, has flowed into passive investing strategies. And where is that money coming from? It's coming out of actively managed funds. And we're going to find out a little bit about the reasons why active tends to do better. So now we have 2 data points. We see that 8% over the long term can beat the index, and we see investors kind of moving in that direction. So we still haven't gotten to the point where we've helped students conceive what is an index. And I can think of no better way to do that than this graphical display, this interactive that we've created of the S&P 500. So Abby is going to chat out this bit.ly link, and we're going to give you some time to just explore. This is kind of those of you who are a little nutty about the markets and percentages and understanding what's going on. We've got a series of questions for you. So we're going to give you about 5 minutes because we've got 5 questions here. And I would just ask, as Abby said earlier, if you could just note, just put the number next to your response. That would help things greatly. And, just as you're wandering around the site, just kind of answer away. And so we will check back in about 3-4 minutes and just start responding as you wish. Thank you.
All right, folks, we're going to wrap up looking at this really awesome visual. Again, feel free to use this in your classroom. You can kind of explore this later on. But for the interest of time, we're going to continue moving. Looking through some of your guys' answers, lots of really great responses. Some people were saying, some of these notes were saying that it's obviously very diverse. You're having different kinds of industries, and so you can demonstrate to your students. You can even talk about the size of the boxes and kind of proportions and what the different colors mean. So like, what does a really bright green mean versus a kind of a darker one? A lot of people saying this is a really fun visual for students. And you also get a good mix of like large and small cap companies included in here. So really awesome. And then clearly, so you're looking at a couple different stocks that grew over 50% in the past year and some that declined. So a couple different ticker symbols that you guys gave me. And then so a lot of people are saying for number 5, it is a pretty diversified portfolio within the U.S. Absolutely. And then, so that could be even launching into a discussion with students about what does that mean for global? What does that look like for businesses that are overseas? So really good discussion prompts there.
All right, I just want to show you one thing about this just to make sure that you, so I'm currently on the page, and again, the chart I took you to was a 1-year performance. You have the ability to change that. So let's say I just wanted to know what the stock market did today, what its 1-day performance was, and you very quickly and easily, those of you who are invested in the stock market, your blood pressure may have just risen. There's a lot of red on the screen. However, when you stretch it out, again, on a 1-year basis, and then, as Abby said, the size of the box is just the market capitalization, the number of shares outstanding multiplied by the current stock price, and then you get a good sense of how companies, their performance really differs. Even though they're in the same sector, you can still see wildly different performance. Like this is the semiconductor industry where Intel was up 7%. And Texas Instrument was down 17. So even companies in the same industry can have wildly different performances. I do realize I need to update because the market, it was easier to find companies that were up 50% probably 3 months ago and harder now. And so probably I should have, that was probably a trick question. There are not many companies that were up 50%. Instead, I probably should have chosen 30%, but you can find some sectors that seem to have done pretty well. Anyway, we've heard from a lot of teachers that does a good job of helping students understand graphically what the S&P 500 is. And then I would just add one other way to help explain mutual funds and index funds, and that is a get out of your seat game we call Let's Make a Mutual Fund. And there's basically, students are given a slip of paper with a company name and their performance on it, which you see on the right here is an example. And so we just recently updated that. So you see Nike is a consumer stock, and it was up 13.71%. Each student would be given a different card, so different company. They form groups of 2, and then you would ask them a series of questions, maybe what their average return was and why they joined together, and then you have that group form with 2 other groups of 2, so for a total of 6. And again, you ask them a series of questions, how they performed on average and why they got together. And if you actually stop right there, Yaneli and our team made a great point that is an example of active management, right? Because in order for them to form a group of 6, they had to find 2 other groups of students. And so they were making decisions as to who they combined with. And it is kind of fun to see all the different reasons students join together. It often is not industry group, or it may be just proximity, for example. But again, you can have a good discussion. Then the final step, and usually I like to set a timer to this, is to just say, okay, now you've got a minute to form a line from lowest return to highest return. Go. And then, so they'll suddenly see that there's a huge variance from the best performing stock, which I think in the Dow was up about 30% last year, to the worst performing stock, which was down about 30. I think it was Goldman Sachs was the worst, Merck was the best. And then basically the big reveal at the end is once you formed this line, is they collectively form an index called the Dow Jones Industrial. And if you have less than 30 students, you're going to have some cards left over and you'll have to do some explaining. But this is just a great get out of your seat game that helps students really grasp the concept of all a mutual fund is a collection of stocks, and all an index fund is some outside third party decides who's in the index, and you just the collection of companies in that index with no decisions being made form that index. So I've thrown a lot at you. Abby and I have thrown a lot at you in the first 35, 40 minutes, and we'd love for you to do a little bit of reflecting. So we've tried different ways to bring index funds to life for your students. So you read a passage, we did some analogies with M&Ms, we had you watch a LeBron James, Warren Buffett video, and then we had you play with the FinViz interactive. So I'd love if you could just take perhaps the next 2 minutes and answer these two questions as you think about what you've seen. And for some of you, I know we've got some folks listening in who have quite a bit of experience with NGPF resources. Maybe you can share of the materials we've gone through what your favorite has been and why. And those of you who haven't used any of these resources would talk about really what one aspect of the instruction that you've seen was particularly effective that you'd want to use with your students. And then question 2 is just thinking about what customizations you might have to make before you get this in front of your students. So I'll give you 2 minutes, and we're real excited to see what you come up with. All right, great responses coming in. We'll give you 1 more minute.
All right, folks. Couple quick notes before I start shouting out some really awesome answers. At the very end of this webinar, I'll be sending out a PD certificate, as well as the answers that you guys are sharing with me right now, because again, we love collaboration and you guys have been giving us a lot of really awesome stuff. And especially with this reflection piece, we have a lot of awesome teachers who are saying, this is how I implemented this in my classroom. I did some group work with this, or I did some peer partnership, things that obviously you guys would also could really feed off of. So I'll provide that in the same email as your PD certificate. So keep an eye out for that. As for this reflection questions, we have Mike, who is saying that he really likes the different modes of displaying information that diversifies what students sees, and it hits on a bunch of different learning abilities. Students are really visual, and so seeing that like group of indexes could be really helpful. And then a lot of people are saying they like the M&M analogy. They haven't heard of that one before, so that's awesome. And then transitioning into the let's make a mutual fund. So starting off with that visual, here's what it looks like. All right, now let's go and get up out of our seats and try it. Krista is saying how she would, one specific customization is that she would use the S&P 500 chart and really customize questions by going into sectors to get students to think about why did the stock go up or down over a set time period based on historical events or decisions and news. So thank you, Krista, for kind of giving that extra piece that you would do with your students.
All right, great responses. So then the next step we're going to take, so we've identified what an index fund is a lot of different ways. And now we're going to get to the nuts and bolts of, okay, so if I want to go out and buy an index fund, how do I do research on it? And so this is an activity we have called Reading the Fine Print. And Abby is sending out the bit.ly link right now. And the first step, I'm just going to have you open up. So if you click on the link, that'll take you to a tear sheet, a one-pager, or actually maybe several pages from Vanguard. And I'm going to answer the first two questions just to orient you a little bit to that fact sheet. So again, the first question is in regards to really what's the index that you're going to be investing in. And if you go to investment strategy, I should probably increase the size of the screen here. That is usually the place you're going to see a description of what this investment entails, and you'll see words like passive management. So students are getting the opportunity to see these terms in context, and you'll see it's, no surprise, it's the S&P 500 index. And so the second question is, who is managing this fund, who's managing this index fund? And that obviously shows up in a couple different places. In the upper left, you'll see the Vanguard sailboat, you'll see the Vanguard logo, and then you'll also see Vanguard 500 index fund. So those are the first two questions. I am going to ask you now for step two, and if you can just put your answers in the chat box again. Now, real important aspect of index funds are fees. So I want you to go back into that one pager and find what the fees are called. And then if someone were to ask you, hey, what does the cost of this fund, what is it? And so again, I want two answers from you. Put them in the chat box. What are the fees on a mutual fund called? And what is the cost of this specific fund? Give you about 30 seconds. Go. All righty, we'll give you another 30 seconds. All right, it looks like we've gotten quite a few responses here. So let me just quickly go to the fact sheet and kind of show you where you find the answer. So the most important information tends to be summarized at the top of the screen here. So you'll see the way we describe, it's funny, if you look for the word cost, you're probably not going to find it in this tear sheet. So it's expense ratio. And the expense ratio for this fund is 0.14%. And so I think it's often good to put that in dollars and cents too. If you have $1,000 invested in this fund, you would pay $1.40 a year. Now, the issue with expenses when it comes to mutual funds is you are not writing a check out to Vanguard. They are just taking that right off the top in terms of your return. It's coming right out of your funds. And so that is an issue because most people don't recognize what the cost of their fund is because, again, they're not writing a check. And it's $1.40 on $1,000. Just for some context, the typical actively managed mutual fund can run upwards of 1% or higher. And so, again, that $1.40 example I gave you, well, you'd be paying $10 for $1,000 invested. It doesn't sound like a lot. The problem is it compounds over time. The same way, compounding interest works, compounding fees also work. And so instead of paying $1.40, you're paying $10, and you do that with higher dollar amounts too. It actually ends up being pretty significant. So let's go to step 3 now. And so the last piece of information I want you to pull out are what are the fund returns? So what were the returns on the Vanguard 500 compared to the benchmark over the last 5 years? And then I want you to just agree or disagree with this statement that the Vanguard 500 fund is a low-risk way to invest in stocks. I'll give you about a minute. Ready, go.
Awesome. Okay, so we're having some people fill in their answers into this chat box. We have a couple of people who are right on the money. And so you have the fund returns compared to the benchmark over the past 5 years. You've got a 0.14. And that, again, comes from the difference. The 0.14 difference comes from Tim scrolling over those 5 years. We have 8.34 and 8.49. And so where does that what does that difference come from? And so we're looking at the market return minus the fees that Vanguard has. And so again, we want to make a point that this is pretty close because Vanguard is as one of the best people out there for when it comes to index funds. And so that comes from the 0.14 that Tim is scrolling up at the top. And then, so that's for question one. Question two is, is this a low risk way to invest in stocks? And so you can find that at the very top left. You have the risk level 1 through 5, 1 being the lowest, 5 being the highest of risk. And again, so right now it's the level 4 because it still is stocks. It'll be less risky than individual stocks, but still high risk at like a level 4. So
cool. Thanks, Abby. Okay, so now we're going to put you to the test here. So you have a choice. You can invest in the Vanguard. These two funds are equivalent in terms of what they own. The Vanguard 500 Index Fund, the investor class, or the Ridex S&P 500 Fund Class A. So I'm going to give you 20 seconds to get your answers in. If you had a choice between those two investments, what would you choose? Go. All right, it is good to see Vanguard across the board. So for me, the fact that the Ridex S&P 500 fund exists shows our financial illiteracy, because these funds are exactly equivalent in terms of what they own. And when you look at the returns, I mean, just look at the 1-year return. The S&P, the Vanguard 500 was down 4.5%. The same fund, in terms of holding those 500 stocks, was down 10.5% at Ridex. So the natural question is, first of all, why does the Ridex S&P 500, and there's like tens of millions of dollars in that fund. And for me, again, that's Exhibit A. And I think this is a great example of showing your students why you have to read the fine print. Because if you just looked and said, oh, my broker is saying this index fund is good, and you don't do the work, you could end up in the Ridex S&P 500. And so, when you look at the impact of that, if you invested $1,000 10 years ago, you'd have $3,300, almost $3,400 with Vanguard. You'd only have $2,800. Now, the problem with that is that your broker would probably be saying, I did a great job for you. I turned $1,000 into $2,800, but it could have been a lot more. And you compound that with larger dollar amounts, like $10,000. You do it over 20 years. I mean, the cost is tremendous. So why the big difference? It's the F word, fees. So when you look at Vanguard again, 0.14%, and this is all transparently disclosed. Somebody's not reading this. Maybe the broker is selling the product to them, because the Ridex fund, I think the Class A also has a load, which, there are mutual funds that are no load, which means you pay no sales fee up front, and then there are load funds. Load funds are typically sold by brokers. And there's absolutely no reason in the world anybody should ever pay a load, and especially a load for an S&P 500 fund, because there are those that are available at no load. Anyway, I'll get off my my soapbox here, but their S&P 500 fund, 1.58%. So again, Exhibit A on why we better read the fine print. So the other thing I want to point out, and I thank Julius for this, because he mentioned to me there's often some confusion around index funds. So Vanguard, I believe their largest index fund is the Total Stock Market Fund, which is listed here, over 3,500 stocks. The Vanguard 500 Index Fund has, surprisingly enough, 509 stocks. And I think part of that has to do with companies coming in and out of the index at times. And again, 509 is pretty close. But then there's also other types of index funds that are more nichey, like the Info Tech Index, which, as you might expect, holds technology stocks, 323 of them. And then there are international funds. And so this is a good example of kind of being able to ask your students which of these index funds is the least diversified. And you hope that they kind of end up looking down at the 10-year average return and say, oh my gosh, the tech index was up 16%. That must be good. That's probably a good example of diversification. But again, that is the least diversified because it is a niche. When you go back to that S&P 500 FinViz chart, you think about that info tech sector, and that's just a small portion. I shouldn't say small. It's like 20% of the index, but it's clearly just a narrow niche. And then obviously comes with higher risk as a result. So that is, I think we have to make sure we educate students that the word index is great, but you also better dig a little bit deeper to see. In terms of what's interesting is the total stock market index over a 10-year period looks very similar to the Vanguard 500 index. It's a little bit better, 0.13%. And so obviously the total stock market index includes both mid cap as well as small cap. So across the cap spectrum. But as it turns out, as this chart indicates, is the larger stocks tend to drive the index, which is why you don't see a huge differential between the two. I think they both have similar fee structures too. You might think owning more stocks, you're going to have higher fees, but I believe they're both kind of bargain basement at 0.14, 13 and the like. So just another thing to keep in mind when we're talking about indexes. So we're now reached time for the final exam. And so what I'd love for you to do now is just answer this question in 3 sentences. So, and this is a very real situation, right? Because I think kids will hear about the guy or gal who bought Bitcoin and made a ton of money, or somebody always has a hot stock and nobody ever talks about the stocks they lost money on. So you think everybody else is winning and this is easy. So your friend tells you about a hot stock or a new company to invest in. Explain why investing in an index fund is likely a better decision. And so to guide you, we're going to ask that you use at least 3 of these 5 terms in your answer: expense ratio, diversification, index fund, mutual fund, and risk. And I apologize because we're already 4 minutes past, but I know this is a group that likes extra credit. And so why don't I give you 3 minutes to kind of power through this. And again, I appreciate you staying on and making Abby and I feel good that you're going to confirm that the lesson we were hoping to teach you got. So I'll keep quiet. We'll be back in 3. All right, 30 seconds.
All right, so we're having people pour in their answers for this final question. Overall, just a lot of really, really great understanding. It's very clear that you guys were all paying attention this entire webinar, so it's awesome. Everyone's using those vocab words, so super great. We have Megan here who's saying the hot stock may sound appealing, but I would advise you to purchase an index fund because it is highly diverse. And if you read the fine print to make sure the expense ratio is low, you have a solid investment you can hold onto over a long period of time. Instead of being the rabbit chasing after the new company, be the tortoise and thank yourself in 25 years.
Tortoise, that's extra credit.
Throwing in that analogy. Awesome. We got Zach also saying, while both individual stocks and an index funds both have risks, the risk is smoothened out in an index fund since you have many companies, whereas one stock could perform poorly even if the market does well. Awesome.
Awesome. And again, we will we'll wrap this in a nice bow for you guys in terms of highlighting some other responses that folks gave. Also, so, I can't ask you to stay. We've already kept you like 9 minutes long. For those of you who want to stay, however, we have this phenomenal new game. Did I just say phenomenal?
No, you can use it again.
I can't use phenomenal. No, we have to show you this game. It's a game called Stacks. And we really built the game because we felt like students weren't getting enough information about index funds. And so this was a way to create an engaging game that really in a 20-minute period, let me just kind of tell you a little bit about it. Students in 20 minutes will do 20 years of investing decisions. So rather than here's $10,000, go invest it, they are actually going to be getting 10 to 15% of the salary is going to appear every basically 30 seconds, and then they have to decide how they want to invest it. There's going to be 7 different investments they experience over time, and there'll be many lessons along the way to teach them about these various investments. They are competing against the computer as well as their classmates, and there's a lot of life happens events. And so I'm going to demo the game for you, and I'm sure many of you are going to be like, I'm not going to wait for the demo. I'm just going to play myself. Well, the game is at buildyourstacks.com. And again, I will play the individual game. There's obviously a group game also, and we have a ton of support documents that actually Abby put together, teacher's guide and the like. And so
while you guys are getting set up for Stacks, for our friends who are not able to stay even past when we're already asking you to stay, when you are exiting this session, make sure to fill out the survey. Just kind of give us some extra feedback on how we can run these kind of really inclusive, interactive sessions. But for those who are staying, awesome. And then for our friends who have to go and have to eat dinner, we thank you so much for joining us, and please fill out the survey. And I'll also be sending out those PD certificates later on today with, just like Tim said, that nice package of kind of other people's responses, so you can see other teachers' feedback.
Yeah, awesome. I want to echo Abby in terms of this is kind of a new approach we're taking to webinars, and boy, your response, your level of participation was awesome. And so let us know how you like it. Previously it was very much a one-way conversation where we were dispensing knowledge, and we just felt like it was time to try more hands-on stuff. So I'd love to kind of get feedback from you as to what the right mix of so-called lecture for webinars versus much more interactive hands-on. Okay, so with that in mind, let's play Stacks. So series of screens here, which are kind of, and we also Abby created PowerPoint slides. So if you want to display this on the board so students can just zip through these beginning charts, they have 7 different investment opportunities, including individual stocks. And let's get started. So the game starts very simply with a savings account. Kind of wanted to start with the basics, so you get a description here of what a savings account is and the importance of setting up an emergency fund, and then we get started. So again, pocket cash, that's the money that's going to be coming in every 6 months. Time is zipping by here. Okay, so free money, I just got $50. These life events are going to happen, both good and bad. So now I have $2,050, and I better start depositing some money. So I'm going to put $2,000 into my savings account, and you will see my net worth grow. And so you have an opportunity to talk about interest, and that's why my savings account is going up. I get another $2,000. Again, every 30 seconds, money is flowing through. And why don't I put that? Oh, I can't do that. I only have $2,000. You're basically limited by your pocket cash as to how much you can deposit. Interest keeps rolling along. I'm going to get to the end of year 1 here. I can see the leaderboard. I'm competing against the computer. This is an individual game. You could obviously create a group game also. I now just leapt past the computer. Again, there's a new investment coming, but first I have to invest in my friend's restaurant. Oh, I don't have a choice. I've got to pay it with pocket cash. So I lose $1,000. There's a new investment opportunity. Now we're going to learn about CDs. And there we go. So I want to buy some CDs with my pocket cash. I've got $1,100. And when I put $1,000 into looks like my 3 month is 3%, my 1 year is 5%, my 3 year is 6%. So why don't I lock it away? So they're learning about the term structure of certificates of deposit. Boom, I bought it. And now if I try and collect on it early, 10% penalty, don't try it. So they're learning about the importance when you put money in a CD, it's going to have to stay there. The computer is starting to take a lead. I have $2,000 to invest. Where should I put it, Abby?
Let's get another CD. What are our rates?
Okay, so we got 3%, 4%, 6%, or 7%.
Let's do a 3 year.
Okay, we're going to do 3 years, and we're going to take $2,000, and now there's going to be another one that forms. And then you'll see this gives you the nice graphic. Oh, I got a new investment opportunity. Now I got index funds. So this is this first opportunity to buy stocks. And now we have a chart here that's showing us the price movement in the market. And so this index fund is an S&P 500 index, which you're all very familiar with now. Let's put $3,000 into that. And we have the ability to toggle between profit and balance. So it looks like I've lost $85 on that investment. Okay, leaderboard, computer is beating me. We'll talk about the computer later. What are my achievements? I've got a couple of achievements here. And okay. Achievements, I got $3,000. Where do we want to put it, Abby?
We are going to, what do you have index? Let's just index.
All right, so you can actually press the max button here and all my pocket cash goes into the index fund. And so again, if this is a classroom of students, my cat has gone viral. Dumb video of a cat, I get $500. I got another new investment opportunity. Now it gets interesting. We get individual stocks. So for the student who likes to trade, like the day trader, we now have given them 5 opportunities to do it. It's Electric, Moneybags, Medco, Big Techco, and Shell Sell. So I like to buy 10 shares of each, just so I know kind of how the market is going for these stocks. So there's nothing scientific behind it. How are we doing against the computer? I'm down by 3,000. I've made money off my index fund. The market looks like it's going up, right? Should we sell, Abby?
Let's do it. Let's go for it.
You want to sell?
Oh, gosh.
Come on. It's still, look, it's going up.
It's still going.
Let's see how my profit's doing here. So let's see, it's Electric.
Let's get 25 of one of these.
Okay, we'll make a little bit of a bet here. It's Electric. Boom, pocket cash goes down. So again, people often get confused as to how to buy stocks. You're just going to click 110 or 25. Looks like you got to keep your eye on your CD. Hey, why don't I withdraw this? Because I want to take it all out and I want to throw it all into, and students will do this. Like they love to take risks. So it looks like I'm making money on It's Electric. So let's max that out. Oof. And boom. All right. Now we've got how much in It's Electric. Not, good opportunity to talk about diversification. We can check my portfolio here. And I think I'm pretty heavy into individual stocks. Yeah, so not practicing diversification, but what's great is, collect on that CD. Boom. Now that goes into pocket cash. Now I can invest it. Okay, I got $4,000. Looks like the market's going up. Your call got dropped. Okay, you dropped your phone. Time for me to upgrade. So let's pay with pocket cash. That's a nice distraction. How are we doing on the leaderboard here?
We can collect another CD.
Oh, there we go. Maybe we want to look. Do we want to do another? Let's see.
Yeah, what's our rates?
Whoa, look at that. So this is all historical data. So you got to keep an eye on the CDs. What do you think?
Let's do it.
How much?
8.6. Let's go 5,000.
All right, we're going to go $5,000 into certificates of deposit. So they're learning about asset allocation here. They're learning about interest rates. We got the stock market keep going up. Looks pretty good. How's our profit going for It's Electric? Not much. That's not so
We really
great.
tried.
We put a lot in that. Whoa, we're up 12%. Oh no, you've got a bad stock. That's big tech. Down 26. Good thing we only have 10 shares. We don't need to worry about it. Computer's crushing me by 13th. Oh no, you've got another bad stock. Where is it?
You've got
There's
7,000
red lights
in
flashing.
cash.
Oh, look at this index fund. I think we need to go here. Let's buy some more. It's running. The stock market is running. Okay, look at that. I like this. I like this here. How am I doing it? Wait a minute.
Still behind.
It's crushing me. Okay, so we're in year 6. The leaderboard's going. We got a little bit of music you could be playing right now, and kids are watching. I wasn't counting on this. So we're getting married, but I have to find the money because I don't have the pocket cash. So we're going to find the funds. Now I'm going to have to sell something. Not so good. Let's see.
How much do we have in It's Electric?
8,000. You want to?
You can pay for the wedding.
All right. Oh, that money came in. I didn't.
Right.
Sometimes if you wait, the money accumulates. So again, I don't want kids thinking the money for pocket cash is just coming, is coming from out of nowhere. This is money that they're saving, and the reason the number keeps going up is the impact of inflation. So it starts at 2,000, and then by the time you get to year 20, there's a lot more money available. Okay, so I think the markets. I want to sell. We got 10 grand in profit here.
Let's just.
Let's get out of there. I think it's starting to fall. Okay, so now we got 34,000. What are we going to do with it? Want to try a CD?
Sure.
Oh, look at that. 8%. I got a vet bill. Okay, we're going to go conservative here because I don't know what's going to happen with the market. 9%. We're going to max out. So again, this is all historical data. This is the real deal in terms of actual information. We got new investment here, as Abby said, government bonds. So again, mix of stocks as well as bonds. They're going to learn about interest rates and the variety of bonds they can own, a 1-year, a 5-year, or a 10-year, and with minimum deposits. So why don't it's interesting. The bonds are pretty flat across. You're not getting rewarded for a long term. So let's do the 1 year.
Mm-hmm.
Okay, we're going to max. And now we're really going to get in trouble if we need cash.
Mm-hmm.
And so this is a good learning. And we're getting crushed by the computer here, 83,000 versus 50. Okay, let's put some money in the savings account. So we feel like we've got an emergency fund we're building. And then we've got the certificate of deposit. I'm all ready to invest. How are we doing here? We have nothing in the index fund. I think it might be time. Let's collect. And then we're going to buy. Anyway, I know many of you, it's dinner time, so I'm not going to make you sit through the entire game unless you want to, but you're getting a feel for kind of how the game unfolds. There's one other investment that comes down the pike eventually, but I wish I could pause it right now, but unfortunately the game kind of continues to roll. Okay, so here we go. We got corn is our latest commodity, and we are starting to close the gap with the computer. So I'm going to move away from the page for a second here. So what are we trying to teach kids? So you do recall, or students, excuse me, you do recall we have the leaderboard here. So in a classroom of 25 to 30 kids, on average, the computer will win about 70 to 80% of the time. And so the natural question is, well, what is the computer? Computer has a very simple strategy, and that is every time pocket cash becomes available for the computer, they buy the index fund. So just dollar cost averaging. It's kind of akin to a 401k plan, but instead of, we're looking at 6-month intervals here instead of monthly intervals. So the hope is, the students who win, be careful about rewarding them, because ask them to play the game 10 times and see how often they beat the computer. The good news is they're going to play a different game each time, because we have 35 years of data on the back end. They're only playing 20 years, and so they get a different game. And we have 20 stocks, and they only see 5 at a time. So the combination of different years plus different stocks. And the other thing we do is, just so students don't become stuck on a name like money bags, money bags, the next time we play, might be a different stock. And these are all real companies. And that gets disclosed. The big reveal is at the end, where you actually get to see. We have to come up with $10,000. Okay, we'll pay for a pocket cash. You see all these life events happen too to distract kids. So we're trying to create. Holy cow, we got $45,000. It's time to put that into the index. The goal is we don't give almost no information about each of these individual companies. We want to create an engaging game that kids are really fired up about. And then at the end, they'll be stressed out, they'll be nervous, they'll have made 40 different decisions in 20 minutes, and they'll feel this is chaos, right? But in the end, our hope is that they see this idea of investing in index funds actually is pretty simple to execute, pretty simple to follow. And so it doesn't have to be about choosing from 7 different investments. It actually can make everybody in the classroom feel like they can be an investor. And so I would only caution you about rewarding the folks who win the game, because again, very similar. Somebody had asked earlier about the stock market game, and we all know the people who win the stock market game are the ones that take on the greatest risk. Sometimes they'll win and sometimes they will lose big. And the problem is the stock market game often leaves a lot of students behind. Either they're not playing well, or they do a ton of research and they don't see the results that take place. And our hope is with this game is that folks see that there is a simple, as Warren Buffett said, sometimes the simplest way is the best. And, rather than tell them that index funds are a good way to go, let them try and beat the market and see how difficult it is to do persistently. And so that's really the purpose of the game. The other thing we've done is we've aligned activities. So if you want to show the students the index fund activity that we have, we make suggestions about what activities we have in our curriculum that give you a way to spiral back to what students experienced in the game. So we really hope, and teachers have told us that they let students play multiple times. So they might play at the beginning, the middle, and the end of the investing unit. And we'll see how they choose different strategies as they go. But we've had over 150,000 students play the game. We've heard from teachers that it's really engaging. It's a little chaotic at first, but I think what we see is students are often better to handle that chaos than old people like me. So I will stop talking and start breathing. And if you have any questions, we'll take any questions that you might have. If you want to just throw them into the chat. But if not, I want to thank you again for joining us today. And we really had a lot of fun and appreciate how engaged you were. All right, so there are several of you hanging on, probably wondering if I can actually beat the computer. So we are down to our last 5 minutes here, and I've got $47,000 in pocket cash. Abby, I'm counting on you. Let's see.
Let's go index.
What is our profit? 28,000. You want to go index?
Yeah.
You want to max it?
I mean, it's the title of our session.
Here we go. Max it with stacks. All right, and we are neck and neck here. Sometimes corn. We had some student who figured out the corn market and was convinced that that was the way to riches. Let's see. Okay, so oh wow, watch that stock soar. Okay, Shell sell was only up 2%. I don't know what the pig's getting so excited about. Yeah, I think if you're doing this with your students, I would practice with the group game and maybe have a student or somebody at home be the guinea pig so you can see what it feels and looks like from the group side. Because what you're going to want to do is the game does not go until everybody indicates they're ready. And the way they indicate they're ready is every time there's a new investment, they have to cycle through the screens. And there might be 5 or 6 screens. And so the student who's not paying attention can hold the game up. For everyone else, the good news is you can actually hit resume to keep the game on track. But you should practice with the group. And I just took the lead versus the computer. Sorry, I just had to note that. Yeah, it looks like the stock market's falling, though, Abby. Should we get out? We got 27,000.
Still 27.
Let's see what CDs. Maybe we'll go say, oh, what happened to interest rates? Ooh.
What about government bonds?
Let's see, bonds. Wow,
Yeesh.
they're really low. So we're gonna have to go. We're gonna have to go CDs. 7. Oh my gosh, what happened?
No.
We should have gotten out early. Look, oh my gosh, it's crashing. The market is falling. I think we're experiencing the Great Recession. Yes, look what happened.
Yeah.
0.81%. Yikes. Oh, we just had a great question come in regarding whether there's a practice site to set up a Vanguard account for students. No, that is something that is on our list because that is the final step, is getting young people and their parents. Unfortunately, if they're under the age of 18, they would need to open an account with their parents. But that's a great question and something we will be sure to add to our new product list because we do want folks feeling comfortable because it is a pretty detailed process in order to open a brokerage account. And so let's demystify the thing by actually letting people set up a dummy account. So thanks for that. Thanks for that suggestion. Okay, so we have just suffered through a tremendous downturn and
we're coming back.
Let's see. I am beating the computer now. So maybe the computer only owning stocks got hammered while I could diversify by putting some in a CD. Excuse me, corn's down 15%. Thank goodness we're not in that. I got to get a new laptop. No, we can pay with pocket cash. And so what's great about this is there is a lot happening on the screen, but what we find is students get it. They're able to navigate extremely well and I think modeling this maybe through the first 2 or 3 minutes might be helpful. Mm-hmm. Just so they understand how to move money around. But then once the game has a little bit of momentum, they kind of take it from there. And the leaderboard is what. And if you teach economics, there's some great lessons here about the term structure of interest rates and kind of how they vary based on the term of government bonds as well as certificates of deposit. Yeah, you can see how much interest rates have fallen. Now we're 0.30%. So I'm getting a sense. Those of you who are students of market history, I think we've hit 2007, 2008. Interest rates nearly go to zero. The stock market crashes, and my computer's running low. Okay, the computer has a $2,000 lead against me.
2 more minutes.
2 more minutes. Actually, you know what? The game ends after 19. We got one more minute. We got $38,000. Okay.
What are you doing with it?
I'm going to get 3 points. Oh no, I got to go all in on the market because we know, again, as a student of market history, the market did pretty well after 2000. So actually after 2008. So why don't we get all of our money? It looks like almost all the money is in the index funds. Let's see. We got 150 out of 190,000. So we should start to see an upturn. I'll take my $1,000, and we're down to our, wow, am I going to hold on here against the computer?
3,000.
Here we go. We only have 10 seconds left. I'm holding on to a slim lead. And wow, this is going to be really close. This is going to be almost, this has never happened before. Let's see.
I can't watch.
I can't watch. Game over. And how did I do?
Nice.
I beat the computer by $3,000. So what's neat about the final screen is it shows you what your performance was, and if you were able to achieve a reasonable annual growth forward at 6%, in another 20 years, you'd have 760,000. The computer wins 70% of the time. And I like the portfolio, and then it gives you the actual years. And so that crash we saw was 2007, 8, and then we had the recovery after interest rates dove down. And then you see actually what the companies are. And so a lot of household names here, Boeing, Aon. Well, not necessarily. Boeing is a household name. The others not so much. So, and then we've got a reflection sheet, which really gets students to think about the experience they just went through, because many of them might feel like, oh, I can handle the markets and the volatility that takes place, and then they play the game and maybe get a more realistic sense of that. But again, the end goal here is that every student leaves the classroom believing they have just been given a very simple strategy that any of them can execute, which is dollar cost average into low cost diversified index funds, just like Uncle Warren said in the video. So I want to thank you again for tuning in, and have a great night.